What if I told you that millions of Americans are buying things they technically can't afford, and yet somehow the entire economy depends on it? Not just houses, not just cars, everything. Phones, furniture, vacations, college degrees, even groceries. In fact, there's a hidden reason why America became the richest consumer economy in history, and it has almost nothing to do with how much money people earn. Because behind the scenes, a powerful system has convinced generations of Americans that owning something today is more important than paying for it today, and that system is worth trillions of dollars. The question is, why do Americans finance everything, and who is really making money from it? If you enjoy business, money, and hidden wealth stories, make sure to like this video and subscribe to the channel, because the truth is some of the biggest opportunities are hidden where nobody is looking. At first glance, financing seems harmless. Need a car? Get a loan. Want a house? Get a mortgage. Need a new iPhone? Pay monthly. Simple. But if you travel to many other countries, you'll notice something surprising. People often save first and buy later. In America, it's often the opposite. Buy first. Figure out the payments later. And that's where the story gets interesting, because this wasn't always normal. In the early 1900s, most Americans avoided debt whenever possible. Borrowing money carried social stigma. People viewed debt as something risky, even shameful. If you couldn't afford something, you waited. You saved. You bought it with cash. That was the rule. Then businesses discovered something revolutionary. What if consumers didn't need the money up front? What if companies could sell products immediately and let customers pay over time? Suddenly, products that seemed expensive became affordable, or at least they appeared affordable. Instead of asking, "Can I afford $200?" consumers began asking, "Can I afford $40 a month?" That single shift changed everything, and it unleashed one of the most powerful economic engines in history. Car companies were among the first to realize the opportunity. In the 1920s, automobiles were transforming America. But there was a problem. Most families couldn't pay cash for a vehicle. Sales growth had limits. Then financing entered the picture. Instead of saving for years, families could drive away immediately and pay later. Car sales exploded. Businesses noticed. Soon, financing wasn't just a tool, it became a product. And products create profits, a lot of profits. But the real explosion happened after World War II. America entered an era of unprecedented prosperity. Suburbs expanded. New homes appeared everywhere. Consumer culture was booming, and banks discovered something incredibly valuable. People loved buying things, but they loved buying things even more when someone else supplied the money. Then came the invention that changed consumer spending forever: the credit card. At first, credit cards seemed convenient. No cash, no problem. Buy now, pay later. Simple. But hidden beneath that convenience was a business model so profitable that it would reshape the financial industry. Because credit card companies weren't just earning money from purchases. They were earning money from time. The longer balances remained unpaid, the more money they made. Suddenly, every transaction had the potential to generate interest, and interest is where billions are born. Think about this. A customer purchases something worth $1,000. The product is sold once, but the debt can generate revenue month after month after month. In some cases, the financing becomes more profitable than the original item itself. That's when financing stopped being a service. It became an industry. An enormous one. But psychology played an equally important role. Humans are naturally impatient. We value immediate rewards more than future rewards. Behavioral economists call this present bias. In simple terms, we prefer happiness today over benefits tomorrow. Businesses understand this perfectly. A luxury couch costing $3,000 sounds expensive, but $79 per month? That feels manageable. The total price doesn't change. Only the perception changes, and perception drives behavior. This is why monthly payments became one of the most powerful marketing tools ever created. Consumers focus on affordability. Businesses focus on profitability. Both sides feel like they're winning, at least initially. Then housing entered the equation, and housing changed the scale completely. Most Americans cannot purchase a home with cash. Without mortgages, home ownership would be impossible for millions. In many ways, financing created the modern middle class. Mortgages allowed families to build wealth through property ownership, but they also normalized long-term debt. 30-year loans became standard. Imagine explaining that to someone from centuries ago, signing an agreement that lasts 3 decades. Yet today it feels normal. That's how deeply financing became embedded into American life. And then something fascinating happened. The financing model expanded beyond necessities. Cars made sense. Homes made sense. But eventually businesses realized almost anything could be financed. Furniture, electronics, jewelry, gym equipment, medical procedures, smartphones, even vacations. The logic was simple. Lower the upfront cost, increase demand, grow sales, and it worked. Consumers bought more, companies earned more, lenders earned more. Everyone benefited until they didn't. Because financing creates a dangerous illusion. It separates the pleasure of buying from the pain of paying. When paying cash, the pain is immediate. When financing, the pain is delayed. That delay encourages larger purchases. Researchers have repeatedly found that people tend to spend more when using credit compared to cash, not because they're irresponsible, because the brain experiences spending differently. And businesses know it. That's why checkout pages often highlight monthly payments instead of total costs. The smaller number feels safer, even when the long-term cost is much higher. But here's where things become even more interesting. America's economy itself depends on consumer spending. Consumer spending accounts for a massive portion of economic activity. Businesses need customers. Customers need purchasing power. Financing increases purchasing power, at least temporarily. Without credit, spending would slow dramatically. Many industries would shrink overnight. Automakers would sell fewer cars. Retailers would sell fewer products. Banks would generate less revenue. Real estate activity would decline. Financing isn't just supporting the economy, it's helping fuel it, and that's exactly why the system keeps expanding. Now we arrive at the secret. How does financing really make money? Most people think lenders simply collect interest. That's true, but it's only part of the story. The real magic is scale. Imagine millions of customers making monthly payments simultaneously. Each payment generates revenue. Each loan creates a predictable stream of cash flow. Financial institutions can package, sell, and manage these streams on enormous scales. A single customer may seem insignificant. Millions of customers become a financial empire. This is why some of the world's largest companies are deeply connected to lending, payments, and consumer finance. The product isn't always the car, or the phone, or the house. Sometimes the real product is the financing itself, and that's the hidden truth many consumers never realize. The transaction is only the beginning. The payment stream is where the real business starts. But the future may become even more extreme. New financial technology companies are pushing financing into places nobody expected. Buy now, pay later services have transformed online shopping. Items that once required saving can now be split into multiple payments instantly. The process is frictionless, almost invisible, and that's precisely why it's powerful. The easier borrowing becomes, the more borrowing tends to happen. Yet there is another side to this story. Financing isn't inherently bad. In many cases, it's one of the greatest wealth-building tools ever created. Mortgages help families buy homes. Business loans help entrepreneurs build companies. Student loans can create career opportunities. Used wisely, financing accelerates progress. Used carelessly, it can trap people for years. The difference isn't the debt itself. It's how the debt is used. And that's perhaps the most important lesson of all. The wealthiest investors in the world often use financing strategically. They understand leverage. They use debt to acquire assets that generate income. Meanwhile, many consumers use debt to buy things that lose value over time. Same tool, different outcome. One builds wealth, the other consumes it. So why do Americans finance everything? Because financing makes expensive things feel affordable. Because businesses earn enormous profits from it. Because human psychology loves immediate gratification. And because the modern economy has been built around the idea that tomorrow's income can be spent today. It's one of the most successful financial systems ever created. A system that helped build modern America. A system that generates trillions of dollars. A system so deeply woven into everyday life that most people never stop to question it. And perhaps that's the most fascinating part. The next time you see a monthly payment offer, remember this. You're not just looking at a price. You're looking at one of the most powerful business models ever invented. Good luck. Until next time.